All right, so we're diving into KIP REIT today. Looks like we've got a whole stack of stuff to go through.
Yeah, annual reports, presentations, all that good stuff should give us a pretty clear picture.
Awesome. Our listeners trying to decide if it's a good investment, so let's see what we can figure out.
Sounds good to me.
Okay, so the plan is to cover their financials, their business model, and the risks. Then, of course, we'll get into what all this means from an investor's perspective.
Makes sense. I was just glancing through this stuff earlier, and it looks like they focus on community malls, which is interesting. Plus, they snagged an award for some seriously impressive returns. Even the Employees Provident Fund is a major shareholder.
Really?
Yeah.
Okay, well, that definitely piques my interest. But first, let's start with the numbers.
Sure, always a good place to start. The 5-year highlights show their revenue has been climbing steadily, hit RM 102.159 million in 2024. But there's a bit of a head scratcher here.
Oh, what's that?
Well, their net property income is up by a solid 25.2%, but their profit actually dropped by 22.2%.
Huh. That is a little strange. What do you think is going on there?
Well, if you dig a little deeper, it looks like it comes down to fair value gain. It was lower this year compared to last year. And last year, there was a big spike because of the market rebound after COVID. Yeah.
So last year's profits were kind of inflated because of external factors, and now things are just leveling out.
Exactly. Got to look beyond just the profit number and understand why it changed, right? I mean, the core business operations are still doing really well, as you can see from that increase in realized profit.
Okay, that's reassuring. Now, I also noticed their debt-to-equity ratio is sitting at 37%. Seems a bit high, no?
Yeah, that's a great point. It's not necessarily a red flag for a REIT, but it's worth comparing to the industry average and seeing how they stack up against other REITs, especially since our listener is thinking about investing.
Definitely something to keep an eye on. Now, how about this? How does this fluctuation in profit impact their ability to pay dividends?
Yeah, that's a big one for REIT investors, isn't it? Dividend sustainability. And, well, this year's profit dip seems mostly due to those fair value adjustments we talked about, but we need to look at the whole picture, their financial health, their business model, all that before we jump to any conclusions about dividends.
Makes sense. Okay, so let's move on to their business model. We mentioned they focus on community malls, but what does that actually mean? And where are their properties?
So they've got 8 of these community malls spread out across peninsular Malaysia. They cater to, the daily needs of folks in suburban areas.
So like grocery stores, pharmacies, that sort of thing.
Exactly. It's all about those essential retailers, not really going after the big, fancy city center malls.
Interesting. And are those malls doing well? What are the occupancy rates like?
Overall, they're looking pretty healthy, averaging around 90%. But like with any REIT, it varies from property to property. For example, KIP Mall Bangui just finished a huge renovation, and their occupancy jumped to 83.9%.
Oh, wow. That's a big jump. So they're putting money back into their properties to attract tenants.
Yeah, they call it an Asset Enhancement Initiative, or AEI, and it seems to be paying off.
Smart move.
Mm.
Now, what about their tenant mix? Is it mostly big anchor stores, or are they relying on smaller retailers?
Looks like they've got a good mix of both. You'll find those big supermarkets and department stores, but also a bunch of smaller businesses, too. Having that kind of diversity is a good thing. Spreads the risk if one tenant hits a rough patch.
Yeah, definitely a smart strategy. Okay, before we move on, let's talk risks. The documents mention a few big ones: interest rates, economic downturns, and tenant credit risk.
Right. Well, let's start with interest rates. We talked about their debt-to-equity ratio earlier, and they do have a decent amount of borrowed capital, so if interest rates go up a lot, it could definitely impact their profitability.
Yeah, for sure.
Yeah.
Especially with all the economic uncertainty these days.
Yeah.
But they must have some strategies in place to manage that, right? I mean, they're not just sitting ducks.
Of course not. They're actively managing their debt, making sure it matures at different times, and exploring different financing options to cushion the blow if interest rates get volatile. Plus, they're running a tight ship, trying to be as efficient as possible. So, yeah, they're definitely not just hoping for the best.
Good to hear. What about the other risks, like economic downturns and tenant credit risk? How do those factor in?
Well, focusing on those community malls in the suburbs gives them a certain level of resilience. People still need groceries and everyday stuff, even when times are tough. Plus, they have a really thorough screening process for tenants to minimize the risk of someone not paying rent.
Okay, that makes sense, but obviously nothing is completely risk-free.
Exactly. We'll have to weigh those risks against the potential rewards, which is what we'll do next.
Right. Because speaking of rewards, let's shift gears and talk about what investors are really interested in: dividends.
Now you're talking.
They are offering a pretty attractive yield right now. But the big question is, how sustainable is it?
And that's what we'll dig into after the break. We'll look at their dividend history, their payout ratio, and try to figure out if those payouts are likely to continue or even grow in the future. So stick around. All right, so picking up where we left off, let's talk returns.
Yeah, dividends. That's what we're all here for, right?
Well, there are actually two sides to the return coin when it comes to REITs. Share price appreciation and, yes, those lovely dividends. Let's start with their track record for generating returns.
Sounds good. I noticed they've been racking up some pretty impressive awards lately. 3 years in a row, they've won the Edge Malaysia Centurion Club Award.
Oh, yeah, for highest return on equity.
Exactly. That's got to be a good sign, right?
It's a great sign. It means they're using their capital efficiently to generate profits for their shareholders. Basically, they're making smart investment decisions.
Okay, so that's promising for potential growth. But let's get back to those dividends. I see they're offering a 7.4% yield right now.
Yeah, that's pretty attractive, especially these days. But remember, yield is only part of the story. We also need to look at the payout ratio. That tells us how much of their earnings they're actually paying out as dividends.
Right, because a really high payout ratio could mean those dividends aren't sustainable in the long run. Do we have any info on that?
Unfortunately, they don't give us a specific payout ratio in these documents. However, they do mention that the distribution per unit, so the actual cash paid out to each unit holder, went up from 6.20 sen in 2023 to 6.67 sen in 2024.
Okay, so even with the profit fluctuations we talked about earlier, they're still increasing the dividend payments.
Yeah.
That's got to be a good sign, right? Shows they're committed to rewarding their investors.
It definitely seems that way. But to really figure out if those dividends are sustainable long term, we need to put all the pieces together, Look at their financials, their business model, those risk factors we talked about.
Okay, so let's recap. Financials are generally solid, though we do need to keep an eye on that debt level. Business model seems pretty resilient, what with their focus on essential needs and diverse tenant mix. And they're actively taking steps to manage those risks.
Exactly. Oh, and almost forgot the elephant in the room. The Employees Provident Fund, or EPF, has a pretty substantial stake in KIP REIT.
Ah, yes. That institutional backing. What does that tell us? Why is that so important?
Well, the EPF is Malaysia's biggest retirement fund. They're known for their long-term investment approach and their very thorough due diligence process.
So they're not exactly jumping into risky ventures.
Not at all. Their involvement suggests they see real potential in KIP REIT's ability to generate consistent returns over the long haul.
Okay, that's definitely a big vote of confidence.
Right.
So, based on everything we've discussed, is KIP REIT a buy? What's your expert take?
Well, based on what we've seen so far, it's definitely an interesting opportunity. Strategic focus, generally healthy financials, actively managing risks. Plus, you've got that strong endorsement from the EPF.
Sounds pretty promising. But I also noticed they're going for a pretty ambitious growth strategy. They want to hit RM2 billion in total assets under management in the next 3 years.
Yeah, that's right. And a big chunk of that growth is going to come from acquisitions. They're actually proposing to buy Depulse Shopping Center for a cool RM 320 million.
Whoa, that's a lot of money.
Yeah.
What's so special about this Depulse Shopping Center, and how does it fit into their overall strategy?
So Depulse is already a well-established mall in a prime location. This acquisition aligns perfectly with their plan to expand their retail portfolio and grow their asset base. It's all about scaling up.
I see. And they mentioned exploring even more acquisitions in both retail and industrial sectors. That's pretty aggressive. What does all this growth mean for those dividends we were talking about?
Now, that's where things get really interesting. If they play their cards right with these acquisitions, choose properties that generate good returns and don't overpay, it could really boost their revenue. And that could fuel future dividend growth.
So there's potential for both share price appreciation and growing dividend income. Sounds like a win-win.
Potentially, yeah. But remember, acquisitions always come with risks. We'll have to see how these deals pan out and make sure they don't get in over their heads financially.
Good point. It's all about finding that balance between growth and stability. So where do we go from here? What are the key takeaways for our listener who's trying to figure out if they should invest in KIP REIT?
I think the biggest takeaway is this. KIP REIT is a company on the move. They're actively pursuing growth, but they're also operating in a very dynamic economic environment. So listeners really need to weigh the potential against their own risk tolerance and their own investment goals.
Right. We've given you a ton of information and insights, but ultimately the decision is yours. It's super important to do your own research, carefully consider those risks, and see if KIP REIT fits into your overall investment strategy. Okay, so we've really dug into KIP REIT, haven't we? Financials, business model, those potential risks, and of course that tempting dividend yield.
Yeah, we've seen how committed they are to keeping those dividends flowing, their strategic focus, on those community malls and industrial properties. And, well, we can't forget that huge vote of confidence from the EPF.
Absolutely. But like with any investment, there are always some lingering questions, right? Like, how sustainable is this growth they're going for? Can they handle all the challenges of this, well, constantly changing market? And ultimately, the big question, is KIP REIT the right fit for your portfolio?
You hit the nail on the head. Those are the tough questions. Let's see if we can connect all the dots and help you figure out how to make a smart decision.
One thing that keeps popping up is this whole changing retail landscape in Malaysia. There's so much competition, not just from other malls, but from online shopping too. How's KIP REIT going to stay ahead of the game?
Well, that focus on community malls in the suburbs might be their secret weapon. They're catering to those everyday needs that you can't really get online. Groceries, pharmacies, all those essential services. It's about convenience and being there for those local communities.
Makes sense. And it seems like their industrial property segment is well positioned too, with all the growth in logistics and warehousing.
For sure. Those sectors are booming and KIP REIT is getting in on the action. So, yeah, from a business model standpoint, they seem to have a pretty solid base for future growth.
Okay, so business model checks out. But what about their finances? We know they have a decent amount of debt, and interest rates can be unpredictable. How worried should investors be about that?
That's a fair point. While their overall financial health is good, we got to keep an eye on that debt level. But remember, they're not just sitting around. They're actively managing when that debt comes due and looking at ways to soften the blow if interest rates spike.
So they're being proactive, not reactive.
Exactly. Plus, they've got a consistent history of profitability and those dividend payouts. And again, that big investment from the EPF really says something about their confidence in KIP REIT's future.
Right, that's a pretty strong signal. So after all this, what's the final verdict? Is KIP REIT a buy?
I wish there was a simple yes or no answer. But it all comes down to your individual situation. What are your goals? How much risk are you comfortable with? Those are things you got to think about.
Definitely. Investing isn't one size fits all. What we've tried to do is give you the tools to make an informed decision. The information, the insights, the different angles.
We've highlighted the potential upsides, we've analyzed the risks, and hopefully given you a framework for deciding if KIP REIT aligns with your own investment strategy.
Exactly. Remember, investing is a journey, not a sprint. Do your homework, weigh those pros and cons, and most importantly, invest wisely.
And hey, if you ever feel lost or confused, don't hesitate to reach out. We're always here to help you navigate the financial world.
Couldn't have said it better myself. Thanks for joining us on this deep dive into KIP REIT. Until next time, happy investing, everyone.